Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of No More, Risk Better, a CreditSights podcast. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy. And today we will be going through our outlook for the media sector with a focus on M&A with our head of media and cable, Hunter Martin, and our co-head of high yield research and head of TMT, Davis Hebert. Davis is here in Charlotte with me, and Hunter is coming to you from the New York City area. So thank you both for coming back on the podcast. I'm looking forward to an exciting discussion.
Yeah, thanks, Zach. Appreciate you having us on.
All right. So, of course, if we're going to talk about media and M&A, we have to start with this Warner Brothers Discovery deal and the latest on that. Hunter, can you just give us a quick lay of the land? And for our listeners, we're recording this on the afternoon of January 20th, since it seems like there's news on this every day. Take us through kind of where things stand, Hunter, and what you ultimately expect to happen in this real world Succession episode or season, or maybe series of seasons.
Yeah. So I mean, I think Davis will agree. This is by far in my 20+ year analyst career, like the wildest M&A situation that I've seen. Like one thing to call out that could be on the Succession episode is just Warner Brothers Discovery, I guess, calling into question Larry Ellison, one of the richest men in the world, his like the validity of him backstopping the debt in a transaction, and that was one of their major critiques. So there's just a lot of wild stuff going on here, and we think there'll be more probably twists and turns to come. But in terms of where we stand now, after Warner Brothers Discovery kind of put itself up for auction late last year, Netflix kind of surprisingly announced a deal not to buy the entire company, but to buy Warner Brothers, which is Warner Brothers Discovery's streaming and studio business. So that's the Warner Brothers Film and TV Studio, HBO, and that's an $83 billion transaction. Initially, it was primarily cash, but also a component of stock. And this morning, after Netflix shares had fallen over time and made that offer, I guess, less attractive, they shifted to an all stock transaction. They did not change the price. So that's $27.75 per share. WBD shareholders will also receive shares in a spun off Discovery Global business, and these are kind of the linear networks like CNN, TNT, TBS. So that will be a separate company. That's supposed to happen by the third quarter. The next step, I guess, in that process is WBD shareholders need to approve this Netflix deal. That vote is going to happen by April 2026, so it's kind of rapidly approaching. And then the regulatory review process will take a very long time. So a deal, if this closes, will probably be sometime in 2027. However, even though Netflix kind of reached this deal, Paramount has not given up. They believe that their offer of $30 per share for the entire company, all cash, was superior, and they kind of have taken an adversarial stance. They've been very critical of the process of WBD's board, and they've made an all-cash tender offer to WBD's shareholders. And a lot of the skepticism on WBD's board comes from kind of, I guess, like the financing of Paramount's transaction. Even with Larry Ellison, they kind of question the amount of debt there. Will they be able to finance it? Will they walk away? So we think now, with Netflix revising the bid, the time has come for Paramount to either finally raise its bid or to just kind of go home and give up. Maybe do a lawsuit that will end up, not settling until well after the transaction is closed.
All right, so Paramount is kind of on their back foot, and when you say they're taking more of an adversarial stance, can you just clarify that in a little bit more detail? I know you say they kind of went directly to the shareholders. How does that fit into like your expectations or probability of outcomes?
So, I mean, I'll get to it in a minute. So we think Netflix kind of is in the front seat and is kind of like the leader in the clubhouse and is likely to kind of close the deal. They'll be able to fend off Paramount. But in terms of like their hostility, even during this auction process, kind of early in the process, they were already criticizing them. They sent like a public letter saying, they questioned the process even before the transaction was done. And they've just been very critical about very critical of the board, which I'm sure WBD's board, has a lot of legal advisors and they believe they're kind of following the proper protocol, right? So normally that is not the best way to get win over, I guess, a board that you ultimately need to approve your transaction if you want to close this, right? But Paramount is kind of playing to the shareholders. They kind of realize, we've already lost when it comes to the board. We need to win over shareholders and get them in turn to pressure the board. So they're kind of I feel they find they're playing to a different audience right now than WBD.
Okay, and so just thinking about how to play this in the fixed income market, how are you incorporating this huge deal into your core views for this year?
Yeah. So great question. So, obviously, I think the way that WBD, Paramount, and to a lesser degree Netflix trade, it is somewhat binary, right? In terms of if you close a transaction where you raise a ton of debt, like that's going to have an impact versus not doing that transaction, right? So acknowledging that, like we are quite confident that Netflix will be able to fend off Paramount, and that flows through to our recommendations. So from Paramount's side, these bonds sold off massively late last year when it became apparent that they were going to try to do this all-cash bid for a company that's several times their size, right? So we forecast under Paramount's bid that like leverage would go up to almost 6 times. Clearly massive, so a ton of new debt that needs to be raised. We think this would drop the company to junk. We think the existing bonds will be primed. We think there would be just tons of execution risk. Historically, these media deals have all been either terrible or horrific, I guess, depending on how they've played out. So we think that then ultimately it kind of reverses that. Although there is some strategic logic to it, like we think when it becomes apparent that they will lose, we will retrace a lot of that spread widening. And we feel that where yields are, we're kind of at a point where your downside is fairly limited, even though it is a binary situation. And given that I think we're closer to kind of a resolution here, so we're an outperform on Paramount. So that's kind of a recent recommendation revision. WBD is a little bit different. So WBD, we believe that if Netflix wins, or as long like they are planning to spin off this linear business, and from our understanding, the current bondholders will reference this very challenged linear business. And in our view, we think that where the bonds currently trade, we're looking at like the benchmark 2032 notes. They trade with around a 6.5% yield. When we look at other comps in the space, like broadcast companies, Davis follows kind of other secularly TV focused companies like a DirecTV or AMC Networks, that trade much wider. We think there is a good amount of downside here to spread. So we're an underperform there, just given that we think the separation will occur. We think these investor sentiment will be poor. We think that business will face kind of double-digit EBITDA declines, and we believe fair value is well above kind of where spreads currently yield.
Okay, great. So we got an outperform on Paramount given they lose. We got a underperform on WBD as it's going to be sort of a challenged other side of this if Netflix wins. So zooming out a bit, how do we view M&A impacting the space more broadly in the media sector? And Davis, you've historically been more focused on the high yield side. Are there any names or themes you're watching in your space from an M&A perspective?
Yeah, no, I'll just say I think this is actually better than Succession. Watching this whole saga between Netflix, the Ellisons at Paramount, and WBD, which is headed by David Zaslav, who's become kind of an interesting media figure. So what you find in covering the media industry is that there's a lot of personalities to figure out on top of just pure financial, financial processes. So at any rate, media has been an interesting sector because I think any consumer you ask would say it's been highly disrupted If you look back in the past 10 to 15 years, everyone watched television. What time is this show going to be on, et cetera, appointment viewing. And now we've moved to this era where there's, significant amounts of content. It's on streaming services. You kind of have this split between general entertainment. You watch Netflix for general entertainment or YouTube. Your sports are still largely on television. So you might say like, this is a sector that looks like it's being highly disrupted by all these, new forces. But when you look at last year's performance in the credit markets, M&A was the driver, underscore, italicize, underline. And so when you look at what's happening with Warner, that was highly influential for returns in the investment grade media sector. In high yield, depending on which credit you owned and et cetera, so sort of a mixed picture. In high yield, after the election of Trump and the appointment of Brendan Carr to the FCC, it's been highly influenced by the strategy of broadcast television deregulation. So you have national media, which is kind of this whole WBD, Paramount, Netflix situation. Local broadcast television is the predominant sector in the high yield market for the media space. So what's happening there? Well, there are two rules that I've been talking a lot about the past year that have been part of this industry for the better part of 75 years, basically since the advent of television back in the 1950s. The first rule is that you cannot have one broadcaster reach more than 39% of TV households. Now that's been a rule going back to the Red Scare and anti-communism, and it has been part of part of this industry structure forever. The second rule is the local duopoly rule. So basically, if you own two TV stations in a market, particularly two big four TV stations, so a station either affiliated with CBS, NBC, ABC, or Fox. So if you own two stations in a market like Charlotte, that's a no-no historically. With this change in administration, basically the FCC is looking to take a wrecking ball to both. So potentially eliminating that 39% TV household cap, and also allowing one company to own more than two TV stations in a market, big four TV stations in a market. So what's happened is we've had a lot of consolidation in the broadcast TV space over the past, I'd say, 20 to 30 years, but this is allowing these super groups to now have strategic conversations that would have been impossible a year ago. So the most recent development was Nexstar agreeing to buy Tegna. So Nexstar is the largest broadcaster. Tegna is one of the largest broadcasters. So this breaks glass in all kinds of ways. So first is it's way over that 39% cap. They actually reach 80% of TV households with their big four reach. And two is they own duopolies or triopolies in more than 30 markets. So to the extent that the FCC and Department of Justice allow this to go through with flying colors, it's going to unleash another wave of consolidation as everyone sort of jockeys for position. So that's been the biggest driver for total returns in the broadcast TV space and the high yield media space the past year. If you recall back to 2024, a lot of people were saying TV, broadcast TV in particular, has this existential crisis. And now it's like, oh, well, now they can just merge and survive. So the flip has been pretty significant in terms of sentiment. So that's kind of what's going on in the broadcast TV space in particular. That's very different from what's happening with the Warner saga.
So is this Nexstar-Tegna deal likely to go through, in your opinion?
It's hard to bet against it not going through. So, the FCC has been, I think, a lot more clear in its intention to deregulate the industry for a couple of reasons. I think one is that these rules are seen as old and outdated, right? So if Facebook can reach 100% of people in the United States, why can't a broadcast television company? It's a fair question. And two is political reasons. So Trump's not been shy about saying ABC and NBC are are, I'll use his words, arms of the Democratic Party, and so empowering local TV stations that affiliate with these network partners is, I think, one way, sort of a softer way to put a lot of pressure on these broadcasters that are not had favorable coverage of Trump. So I think that's been driving a lot of that sentiment. And so from the FCC's perspective, it seems like there shouldn't be an issue. Now the question is the Department of Justice. We don't really know exactly how they're going to look at it. Could they look at markets where Nexstar-Tegna have 3 TV stations and say, hey, you've got 80% of local television ad dollars, like that's antitrust issue, right? We'll make you sell a station in those markets. That's the big TBD.
All right, I think there's probably a lot of politics and concern about controlling that much of a market, but we certainly don't need to get into that on this podcast. So I want to shift now to sports. So we're recording this the day after Indiana capped off an incredible season, winning the college football national title last night, and we are heading into conference championship weekend for the NFL. How do you guys see the sports landscape unfolding in 2026? What are the key themes you're watching there? Hunter, I'll start with you.
Thanks. Yeah, I'll kick off here. So the big thing I'm watching is the evolution of cord cutting, and specifically something called skinny bundles. So I think we've all been aware that people continue to drop their big TV package. This has been happening at like 6, 7, 8% per year. Last year ended up being a little lower than expected, and like the mid 5%, I believe. But this is a huge driver for the financial performance of all these companies that have broadcast and cable TV networks, right? It's just how many people are paying. So we're always looking at that, and we think the big kind of unknown this year is what's going to happen with, or one thing that we think will happen this year is we think more people will switch from like a very large bundle to what are called skinny bundles. A big reason that people kind of cut the cord is that the price is just very high. It keeps going up. You complain, oh, I only watch a few channels. I mainly watch Netflix or Amazon. Why am I paying for this huge package of channels? So there's always been this desire to kind of like, how can we make this lower price? And the other thing that we're aware of, and we think was probably a driver of that slowdown in cord cutting last year, is we think that over time, the customer base, right, the paying customer base, anyone who didn't care about sports or news, which are best consumed live, they've been cutting at like a much faster rate. So we think some of it could be that just when we look at kind of the concentration of the remaining pay TV subscriber base, you have a lot more sports and news fans left. And that could be something that kind of supports us going forward, right? The people, it's like a more resilient, lower churn customer base left. However, one thing that we're seeing, and it's going to happen soon this year, is YouTube TV, which has become kind of a dominant player in the industry. It's what we call a virtual MVPD, or virtual TV distributor. You can sign up for 1 month at a time, unlike back in the day when you had to sign up for DirecTV for several years and pay a huge fee if you tried to cut. So they've been growing rapidly, and they announced late last year that they're going to launch 10 different kind of genre bundles of packages, presumably at lower price points, and this could kind of appeal to a wider variety of customers. So we haven't seen, they're going to be in early this year, but we haven't seen the pricing. And one thing we're really watching is how aggressive is the pricing going to be on this kind of sports bundle? Because what we believe will happen is it will be priced lower than the overall bundle. We think that will be attractive to a lot of people because as some of you I personally experienced this. It's very annoying to try to cobble together all the different streaming services. It is nice if you're a sports fan to kind of have all the networks in one place, and the linear bundle is good for that, or just the pay TV bundle is good for that. So we think this could be appealing to a lot of people. And what happens is, while this could kind of support the broader cord cutting trend to be useful for the industry or helpful for the industry, it does create winners and losers, right? So it's like there's going to be a lot of networks that are not included in that. If you are a company like AMC Networks or Paramount, where a lot of your networks are like Nickelodeon, MTV, these are general entertainment networks. They're not going to be included there. So if you have kind of customers migrating toward these new packages that you're not included, you're going to see a lot more subscriber pressure. You're going to show weaker trends in the rest of the industry. And you probably have more risk when it comes to renewals and things like that. So that's something that we're very cognizant of. We're watching. We're kind of excited to see where YouTube TV prices these skinny bundles. So that's the big thing I'm watching on my side when it comes to kind of sports in 2026 and how it affects our media coverage.
Yeah, that's really interesting about the downshift in cord cutting last year and the consideration that maybe you're reaching a critical mass of the cord cutting viewership. Is that kind of the point, Hunter? And so, do you think that that could continue moving lower?
So we saw in the last 2 quarters of the year, the pace slowed down. So we just had less cord cutting than we had anticipated. And this was interesting because it came at the same time that Fox and ESPN launched their direct-to-consumer streaming offerings. So heading into last year, that was a big fear because traditionally it was like if you want to watch football on Fox and ESPN, tons of college football, good NFL football, you needed to subscribe to the normal bundle because ESPN and Fox, they didn't sell their stuff on an a la carte basis. So, and both of them launched, direct-to-consumer services like late last year when the football season started. So it was interesting that despite them launching something that theoretically should have resulted in more churn, like churn actually went down. Now we think some of that is due to the fact that they price those offers like very not in a consumer friendly manner, right? There in one way they were priced to kind of highlight the value of like, hey, this pay TV bundle is a pretty good deal. You don't want to pay $30 for one, $20 for another. It's like, hey, maybe I should just spend the extra money to have everything. So that is something. So it was interesting that happened. Despite what should have been a headwind in the other direction. So this is only 2 quarters that we're looking at as well. So it could just be like a blip that, we see an acceleration anyway. But
That's really interesting perspective. Not that I follow this nearly as closely as you guys, but I think that's kind of an interesting thing to keep in mind. Davis, what's kind of on the top of your list in terms of themes for sports in 2026?
Right. Well, I think that what's obvious to me is how important sports have become for television. If you look back to 2005, only about 15% of the top 100 programs on television were sports. 15. If you look at 2025, 95%. So 95 of the top 100 programs were sports. 92 of those were football. So the only three that were not football, or four, I guess, was Kentucky Derby, March Madness Championship, and Game 6 and 7 of the World Series. So
wait, so these are individual events, sports events,
sports programs, yeah. So like Monday Night Football, Week 8, or NBC Football, Week 9, yeah. So basically, cable, what we used to call cable television or pay TV is now basically a sports medium, right? Because and it might speak to some of the cord cutting, relief we've seen as things continue to get more and more fragmented. But at any rate, my point is that sports is highly important. Football is critical, and so we're constantly looking at sports rights and what's coming up for renewal. And the big fear has always been Netflix or Apple or YouTube saying we're going to pluck those rights out of the traditional ecosystem. And so far, that's happened here and there. It hasn't happened in a full force way. Now the good news is there's not that many material rights up for in 2026. The NBA just extended last year. MLB has now pushed everything out to 2028. NFL has an opt-out for its deals that expire in 2033, beginning in 2029. However, the NBA deals from last year sort of set this new high watermark for values. So, for example, Amazon pays 1.8 billion a year for the C package of the NBA. It pays 1.3 billion for Thursday Night Football for the NFL. Now, I'm not a betting man, but I'd bet the NFL viewership is way above NBA. So all of a sudden, the NFL looks incredibly undervalued when it comes to these rights deals. And the NFL knows this. And so they are saying, how about we bring forward this whole renegotiation process in 2026 or maybe 2027, who knows? We want to get paid fair value, like so. Judging where the NBA printed, we want obviously better than that. And like I said, 95 of the top 100 programs were football. Can any of these media companies afford to lose it? Absolutely not. Cannot afford to lose it. And so they're going to be ponying up more money for that to the extent those rights are open back up. So I think what we're looking for is if those rights stay on traditional media, this whole existential question of how long is TV going to last in this Netflix world, that question actually potentially lengthens into the 2030s to the extent NFL remains on broadcast. So I think that's going to be a incredibly interesting development in 2026.
Yeah, that's a pretty incredible spread between the latest NBA deal and NFL when considering just how much more popular NFL seems to be.
The other interesting stat I just looked at over the past week was NBC released its viewership numbers for the NFL season, and I think Sunday Night Football delivered 23.5 million viewers per Sunday Night Football game. 21 of those 23.5 million were on NBC. 2.5 million on Peacock. So to the extent, like if you look at overall television viewership, everything, entertainment, sports, whatever, it's about 55-45 streaming versus television, traditional television. If you look at NFL, based on those numbers from NBC, from Comcast NBC, only 10% of the audience for NFL is on streaming. So that again kind of speaks to how critical it is that they keep that.
That's a pretty wild discrepancy, but kind of gets back to the difference between those people that value news and sports, which you want to consume live, and kind of everything else in the broader entertainment category, thinking about the spread there between streaming and pay TV or cable, whatever we call it now. All right, so I want to round this out and kind of get your perspective on how this all fits into the overall cable network story in 2026. You guys just put out a great note highlighting your key themes for the media sector this year, and you kind of note how Versant trades at a paltry 4 times EV to EBITDA, highlighting public markets' distaste for cable names in particular. Do you think this leaves the sector susceptible to more private activity going forward? What other key things are you watching for the cable networks?
So I'll start on that. So I definitely do. So normally when you see these cable networks, when you see an industry basically where it's cable networks are very clearly in secular decline, right? Like the companies themselves admit it. It's very apparent to investors because you're losing your revenue, right? You're losing viewership. Your profits are going down. However, they're also very cash generative, right? So like unlike streaming or movie studios where you have to invest an immense amount, like when you have a mature business like this, that they still throw off a lot of cash, and we think the pay TV bundle will continue to exist. So there is kind of a long runway for these businesses. So normally when you have that type of industry, I think what we tend to see, or the common playbook, is there is consolidation, right? So it's kind of like, you see the existing companies, they're like, we're in decline. However, what can we do to kind of extend our lifespan, right? So one thing to do is as you shrink, you can combine with other companies. You take out kind of, duplicative overhead. You maybe scale up a little bit to give you a little more negotiating leverage with your distribution partners. And we think that's what's going to happen in this, in this cable network industry, or that seems like the path to follow. And then it raises the question of like, who is going to be the one that consolidates here? Who's going to roll up these businesses? So far, we've seen Netflix and I guess Warner Brothers Discovery not Netflix, Comcast, right? They spun off Versant. Warner Brothers Discovery is going to spin off Discovery Global. They've said like, we're not going to buy more. We want to actually get rid of these. So it's like, who is going to buy these? Is it a trade player? Where I think when you're talking about as a credit investor, right? Like as a bondholder, I would much rather be a bondholder in a company that's a listed public company than one owned by private equity. So is it trade buyers? Does Versant or this spun off Discovery Global, are they the ones that start kind of buying up subscale assets, or does it go to private equity? In my view, I'm really interested in terms of where, does this sub 4x level for Versant hold up? And then how does Discovery Global trade? Because like, I think just back of the envelope at that type multiple or that type valuation for the entire company, I'm pretty sure that private equity can buy those, like put on some debt, use these early years of cash flow, quickly kind of get their money back, and then it's kind of a free roll. And again, as I said before, as a bondholder, I cover mainly IG, like I really prefer, like, a lot of things can happen. Like, sure, you could get lucky, you could get a change of control at 101 or something. But I'd much rather have, industry players, kind of build themselves back up. But I think if we're at 4x, like the public markets are not going to like that. That's not going to be a good strategy for, Versant's management. So that's something I'm watching, how that trades. And I think my view is ultimately, like, I see it more likely that private equity kind of rolls up these entities, runs them for cash, cuts costs, sells off some assets that we don't even know exist, some international cable networks or some little digital property. And we've seen that, I think, with like DirecTV. Maybe Davis has a little there, but like that was one. I think private equity did a great job, buying that. It was a little lower leveraged, but got their money back quite quickly. And I think it's turned out well for them, or at least as from an investment standpoint for the buyers, for the owners.
Yeah, that one has worked well, and I think just to add on, like, why is Versant trading at 4x EBITDA, right? If we've talked about, the NFL might extend the life of television into 2030s, and I think we did a big sports primer a couple of years ago. We looked at like what is the right way to reach fans, and I think the conclusion we came to is a lot of games were on cable TV like ESPN. Right now, the approach is basically to split rights between streaming on one side and broadcast on the other, which leaves cable sort of nowhere. So that speaks. I mentioned like the existential crisis of television. If NFL stays on broadcast, that potentially lengthens it. For cable TV, it does not go away. The existential question of what happens to cable networks. I think if you look at the next few years, yeah, they're going to be around. They're probably going to be declining. They're going to be generating free cash flow. If you look into the 2030s, all bets are off.
All right, so don't bet on cable anywhere past 2029.
More or less.
All right, well, we covered a lot here. I think we hit most of the key themes you guys pointed out in your note. That was extremely helpful for me. Obviously, a lot more to go on a lot of these key stories, but I think a lot of interesting themes and trends in the space for our clients and general investors to be aware of. So again, to Hunter Martin, our head of media and cable, and Davis Hebert, our co-head of high yield research and TMT, we thank you for coming back on No More Risk Better.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security.
The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.